If you want to hear my thoughts about the pros and the cons to standard conventional Fannie Mae and Freddie Mac financing, then you are definitely in the right place right now. Thanks for tuning in, and be sure to stay tuned for con number 4 in this video, as this is one that you really need to be aware of in certain instances. And if it applies to you, it is going to be to your advantage to have a basic understanding of this con number 4, what LLPAs are, and what it means to you financially as you plan to move forward with certain types of home purchases if that is on your horizon. Matt Pfeiffer here, NMLS ID 296861, better known as the Fishin' Finance Guy. So when it comes to standard conventional financing, so again, if you watched my video from last week, that would be Fannie Mae or Freddie Mac. There are some pros and cons. There, quite frankly, are pros and cons to every loan program that is available in the mortgage market today. But let's dive right in. So with Fannie Mae and Freddie Mac, pro number 1, there is no standard or mandatory loan-based upfront fee. I don't want to get into the details of other loans because that is not what we are discussing today. But for example, with an FHA loan, there is an upfront fee that comes along with that product. So regardless of the interest rate environment, regardless of the interest rate that may be offered, regardless of any points or fees that may be associated with that interest rate, remove all that from the equation, there is a 1.75% fee that gets typically financed onto the amount that you're borrowing. So you can pay this out of pocket if you are acquiring an FHA loan, but FHA allows that to be financed on. But regardless of the other details of your transaction, that fee applies. In the case of a VA loan, some veterans may be exempt from the veterans loan funding fee, some may not. My point here is not to dive into the details of VA financing right now, but again, with these other products, there sometimes always, sometimes maybe, an upfront charge simply affiliated with the product itself. And with Fannie Mae and Freddie Mac on standard conventional loans, there is no upfront fee that applies. So, pro number 2. Depending on the details of your transaction, you may be eligible for what is known as a property inspection waiver, common industry jargon, and appraisal waiver. Now, with some of these pros and cons, there's truthfully a little bit of perspective here from the standpoint of who's looking at what this feature is. So depending on the individual and their perspective, a pro might actually be a con, and a con possibly could be a pro. I'll try to break it down and keep it as simple as possible. There is ultimately an algorithmic formula internally within the automated underwriting platforms with both Fannie Mae and Freddie Mac. And when a potential transaction gets submitted through that electronic underwriting platform, it's looking at every variable and every detail tied to both the client in terms of their income, employment, job stability, and all those other variables and details. But it's also looking at sales data for where the home is located. What is the type of property? What is the price point relative to recent sales in the area? So there's a lot of things that are analyzed, but in many instances, if the system is comfortable with all these little variables that go into this assessment electronically in their platform, you may not be required to have an appraisal done. Now, here's where that's possibly a pro and possibly a con. If you're looking at that from the perspective of, let's say, a mortgage lender or the bank or a real estate agent involved in the transaction, or possibly even the title company involved in the transaction, that is almost always going to be viewed as a positive because it's one less item that could possibly create a problem from that transaction getting to the closing table and everybody getting paid. However, from the standpoint of the consumer or the client, they may still want to have an appraisal done. You may want to have that done to ensure that at least at the moment in time that you're purchasing the property, you are not paying more for the property than what an independent appraiser would deem the fair market value is. Now, on the other side of that, from the consumer perspective, let's say you're in a hot market and it's a seller's market and you have multiple buyers putting offers in on a property and this is the home that you want, and you're not overly concerned about whether you might be paying $10,000 or $20,000 above what an appraiser would deem the value of that property is. Well, that is definitely a positive thing. Then number one, it saves you $400, $500, $600, whatever the fee in your local area may be from the standpoint of the cost of the appraisal, but it is also one less item in the context of your mortgaged transaction that could lead to a problem or an issue within the details of that transaction. So, from a seller's perspective, if you're financing the purchase, but they are aware of the fact that you do not need an appraisal, that might make your offer stand out above others if that's not known to the seller in regard to the other offers. And if you're comfortable with whatever the price is that you're offering for that home, you may not be too concerned about what the fair market value might be today because you want that home and you know that's the right location for you and your family, or it's putting you in the right school district for your children. So, an appraisal waiver, I have no way of telling you specifically and exactly why in some cases it is offered and in others it's not. Again, lots of variables go into that, but depending again on the perspective of the individual, that could be a pro, it could be a con. All right, so pro number 3. As compared to, let's say, once again, an FHA loan or a VA loan, an appraisal, when it is going to be utilized on a Fannie Mae or Freddie Mac transaction, is typically going to be a little less in depth than on those other loan programs. So, what do I mean by that? Well, when any appraisal is done for a mortgage transaction by an individual licensed appraiser, the primary goal and purpose of that appraisal is a couple of things. Number one, without an appraisal, the lender or the bank truly really doesn't even know, is the collateral for that mortgage loan actually in existence? And what I mean by that is, without an appraisal, a property could have literally burned to the ground yesterday, and a lender would not be aware of the fact that that collateral doesn't exist. Now, there's no instance that I can think of where a buyer would actually proceed and go to closing on a piece of property where the collateral and the house itself had burned down yesterday. But the point is, when an appraiser goes out, there are photos taken. So it's documenting to the lender, hey, this is the collateral for the money that you're going to be lending to this client. Here are interior photos, exterior photos, street view photos, backyard, front yard, etc. So the other primary point of an appraisal is to determine independently through that appraiser what the fair market value is of that home at the moment in time that the appraisal is being done. So things are looked at like features, amenities, square footage. Does it have a pool? Does it not have a pool? Is it on water? Is it not on water? Does it have a water view? So all these kinds of things go into that valuation assessment, along with what are other transactions in the recent past in a fairly tight proximity to that subject property. What do those numbers look like as far as what was the sales price on that home or those homes, and how similar in nature are those to the subject property? But when it comes to an FHA loan or a VA loan, it is very possible the appraiser, so the individual human being, it could be the same appraiser that did an appraisal last week on a transaction that was a conventional loan. They have just gone through the licensing and the steps and the registrations and all that sort of thing to be authorized to do an appraisal on behalf of an FHA transaction or a VA transaction. And typically, what you're going to find on those loan programs, the appraiser needs to be a little more in depth in terms of their assessment of the property. So one just very simple example. FHA has a health and safety element within the rules and guidelines for what an appraiser needs to comment on or notate. So if a given property has a couple of steps leading up to a door on the outside of the property, and there are no railings in place to get to that door, and let's say it's just 3 steps, property's a little elevated or the ground slopes off, well, on an FHA transaction, historically and typically, there would need to be at least one handrail installed in order for that transaction to close, because that is a health and safety item. Someone could be walking down the stairs, slip, and need to grab a railing. On a conventional Fannie Mae or Freddie Mac appraisal, something like that is likely not going to come up and be noted or pointed out by the appraiser, nor is it necessarily a requirement under the program guidelines. So it's little things like that where I know in conversations I've had both recently and just over the last 29 years, sometimes from a seller's perspective or a real estate agent's perspective that is representing a seller, they may be a little hesitant to accept an FHA offer or a VA offer over a standard conventional loan offer or a cash transaction, simply because they don't want any surprises or issues that may develop as a result of that, and impede the rate of progress to get to closing or create problems that maybe can't be overcome, and then they need to relist the home back on the market and find a new buyer. So there are a lot of little things like that relative to health and safety, overall livability and habitability that may come up on an FHA or a VA loan, or possibly even a USDA loan, that likely would not come up on a standard conventional scenario. So that leads us to pro number 4, PMI. So in summary on PMI stands for private mortgage insurance. And this is that item that most people right off the bat really do not want to have to pay. And it's understandable. Now, I'm going to do some videos on PMI because there's a lot that needs to be shared about PMI, and it's not as bad in many instances as the general perception out there by an end user or consumer. But on a conventional loan, if PMI is going to be required at the time that you purchase the property, and that is going to apply generally if you are putting down less than 20% in the way of a down payment. But on a conventional loan, the PMI at some point in the future is going to be cancelable or forgivable. So there are a lot of little rules and nuances and guidelines pertaining to that, but that is not the point of this video. So we're just going to leave it alone that if you are utilizing conventional financing and you are putting down 3 or 5 or 10 or 15% at the time of the purchase, and PMI is part of your transaction and included within your monthly payment, at some point going forward into the future, it is very likely that you will see that PMI removed from your payment, whether that is automatically in certain instances or possibly upon request in others. But on an FHA loan, for example, at the time of recording, and we are here in the fall of 2025, the monthly mortgage insurance component on an FHA loan is currently for the lifetime of the loan if you are putting down less than 10% at the time of purchase. If you put down 10% or more on an FHA loan, then it too would eventually drop out of the monthly payment at some point, typically around the 11-year mark. So now that leads us into the cons, or the negative, or the downside of conventional financing. So con number 1, in a broad overview general sense here, the guidelines on conventional financing are a little tighter or a little more restrictive, let's say. And I'm going to kind of focus this truly in on both credit score and overall debt ratio. So if you compare a conventional loan and a client's details inside of a conventional loan, if they are at an upper level on their debt ratio. You're going to get to a point where you are no longer going to be qualifiable for a conventional loan, but on an FHA loan or a VA loan, that number may be higher. So if your debt ratio is a little bit on the tight side or right at that limit for conventional financing, but the price of homes in your area or the loan amount that you're needing for what you're looking to do puts you into that debt ratio level beyond the approvable side of a conventional loan, you may be able to resort to an FHA loan or consider that as an option because there is some more flexibility there. And then when it comes to credit scores on a conventional loan, the conventional financing world, so Fannie Mae and Freddie Mac, very, very sensitive to where your credit score falls within the details of your overall transaction and your pricing. So if we're going to say that 620 is the entry level for conventional financing, you are going to be in the worst pricing bracket or tier, if you will, if your credit score falls between 620 and 639. If your credit score is between 640 and 659, any of those adverse pricing adjustments or risk-based pricing adjustments that may apply, they're going to get a little less because you're now 640 to 659. And this continues all the way up to around 740 and beyond. So 660 up through 679 is another tier. 680 through 699 is another tier. 700 to 719, 720 to 739, and then typically for most scenarios, when you are 740 or higher, you are then in, let's say, the A plus category, and any adverse pricing adjustments or risk-based pricing adjustments are going to not exist anymore, or they're going to be at the smallest level applicable once you're over that 740 mark. So both on the credit side as well as the qualifying and the debt ratio side and how much you may be eligible to borrow, the conventional side is a little more conservative, a little more restrictive, and definitely has some elements of being punitive if you fall into that lower credit score spectrum. So that's going to lead us into con number 2. In today's market, when you look at the pricing options for a consumer as it pertains to, well, what is my interest rate going to be on this transaction? In almost all instances, at this moment in time, there is going to be some level of a points or a fees charge that coincides with your transaction. Now, I don't want to get too deep into this because I could talk on this for a long time. But in years gone by, and this, I'm going to say years gone by, let's say that 2021 and beyond, going in reverse, before we went through this rapid rise on interest rates that we did a few years ago, you as a consumer had a whole wide range of interest rate options that would have been available to you. If you were looking for the absolute lowest interest rate that you could obtain, you could certainly do that, but that's going to come with a cost. But if you were willing to accept an interest rate that was, let's say, a little bit, or maybe even a lot above what the going market rate would have been, you typically could receive a generous credit at closing from the mortgage lender. And essentially, this is a byproduct of like the secondary wholesale level, the mortgage market. At this moment in time, we do have scenarios where we can see options where you can get any points or fees minimized or maybe generate a small credit back to you at the time of closing. But because of the fact that the mortgage industry is a long-term industry, so when these loans go to the secondary market, get bundled up and securitized and sold off as mortgage-backed securities and coupons on Wall Street, the intention is that they're going to be on the books for an extended period of time because oftentimes it's a 25 or a 30-year mortgage, and there is an expectation of payments coming in and interest being generated through that coupon being available. So with that being said, When you are in an elevated interest rate environment, and then you combine that with, at this moment in time, expectations and projections looking forward, that we are likely going to enjoy a lower interest rate environment kind of just on an ongoing basis going forward, the secondary level of the mortgage market is anticipating the fact that once rates improve enough, and whatever that number is for a given household doesn't really matter. Point is, things have compressed and gotten very tight on that secondary side of the market. So those rebates and credits generally don't exist. In years gone by, if you ever heard a radio ad or had a local lender, talking about, we'll pay all your closing costs if you come and refinance with us. Well, generally, in most cases, that's how that would have been done. You get a slightly higher interest rate than maybe what the best going market rate is. But in exchange for that, there was this revenue that was created and credited back to you at the time of closing to cover transactional expenses and costs. Well, right now that doesn't really exist in the level that it did before. So even for a very clean borrower with a good credit score and a solid down payment, everything just being like an A plus scenario, there is usually still at this moment going to be some level of cost associated with most of the interest rate options that they're looking at. And it is just a reality of the market that we're in right at the moment. So that is where working with a lender that's going to share your options, discuss these things, look at short and long term, positives and negatives relative to your transaction really comes into play and is critically important to make sure that you end up making the right financial decision for you and your family. I'm going to then now jump into con number 3. And that is very simply that with a standard conventional Fannie Mae or Freddie Mac loan, there really are no alternate forms of income documentation that can be utilized to help you qualify. Since Fannie and Freddie are government-sponsored enterprises or government-sponsored entities, essentially, if you want to take advantage of those programs and get your hands on those mortgage dollars, they want to qualify you based on income that has been declared and taxed. So while there are, as I mentioned in my one of my prior videos, non-QM loans where you may be able to provide bank statements in lieu of pay stubs, or you may be able to take advantage of, let's say, a DSCR loan to qualify an investment property purchase in lieu of providing tax returns or W-2s. With standard Fannie Mae and Freddie Mac loans, there really are no alternate documentation sources. It's pay stubs, W-2s, tax returns, 1099s, business tax returns. Now, not all scenarios are going to require all of those items, for a 2 full year history, because there are a lot of little variables and nuances there where some scenarios may have less documentation needed than others. But the reality is 1099s, tax returns, W-2s, K-1s, all that sort of standard income documentation is going to be required on your standard conventional Fannie Mae and Freddie Mac loans. That leads me to con number 4, and this is the one that you really need to have a basic awareness and understanding of. What I'm going to do, because I want to talk through a visual image for this con number 4, but it is something that is known as loan level price adjustments. So because Fannie Mae and Freddie Mac allow financing for a primary residence, as well as a second or a vacation home, and also an investment property, those have their own pricing adjustments and variables, and there are different ways to qualify a client based on what they are intending to do with the property at the time that they are applying for the financing. So when we look at the details of what Fannie Mae and Freddie Mac are imposing onto a transaction based on the details within that transaction, there are going to be pricing adjustments that come into play. Those are known as loan level pricing adjustments. Now, historically speaking, if you were looking to qualify with tax returns and W-2s to purchase a rental property for yourself, historically and typically, the terms on that were going to be less attractive than if you were buying it as a primary residence for yourself, with you being the end user of the property. There is inherently more risk in a property being purchased as a rental. And then there is also the element that the the industry or the loan program knows you're purchasing the property to generate income from it. So there is a cost that essentially comes along with that. A couple of years ago, however, 2022, if I am not mistaken, spring of 22, the government introduced some very aggressive changes to the loan level pricing adjustments for anybody looking to purchase a second or a vacation home. And I'm going to bring an image up on the screen, and then I'm going to do a voiceover walkthrough of what this means, simply and exclusively for you to be aware of this if making a purchase of a piece of real estate as a secondary residence or a vacation home is something that you're thinking about now or maybe planning on for the future. Now, I don't know if these pricing adjustments are going to stay in place on an ongoing basis, but they have been there for over 3 years now. So I don't have any expectation of those being redacted or retracted anytime soon. But I want to walk you through that quickly, just so you have an understanding of what you might be dealing with, that that's something that you are considering doing or looking into at some point going forward. All right, so this is the information that you need to know if you are considering purchasing a second or a vacation home. Now, what I will clarify, just because this question has been posed to me numerous times over the years, a second home does not necessarily represent that it is automatically and only your second house. A second home encompasses any secondary residence that you may utilize. So you could have 3 second homes. Let's say that you live in Minnesota and you enjoy skiing in Colorado. You could have a second home in Colorado. Let's say you also want to have a little beach cottage or a getaway down in the Florida Keys. You could also have a second home in the Florida Keys. And let's say that you enjoy camping in the Smoky Mountains. You could have a second home in the Smokies somewhere in the Carolinas. So each one of those is considered a secondary home if it is a place that you are going to spend some portion of the year, whether that's 2 weeks, whether that's a month, whether you're 3 months at one and 3 months at another and 2 months at another, and then 4 or 5 months at your primary. So just understand, second home doesn't simply mean it is the number 2 house that you own. It is simply another residence that you may spend time at. So again, you could have 2 or 3 second homes. Now, with that being said, this grid, I blurred out some information here that was a couple of alternate loan products that for most people typically wouldn't apply, because my focus on this is really for anybody considering a second or what also could be known as a vacation home. So this reference here as to current loan level pricing adjustments, this was at the time that this was published just prior to March 7 of 2022. So what these numbers basically mean here is that if you were purchasing a second home prior to March 7 of 2022, it was priced the same as what your details would have dictated for a primary residence. So simply meaning, just pick the kind of the middle column here. If you were putting down somewhere between 20 and 24.99% on a second home purchase, there were no pricing adjustments because of the fact that it was a second home as compared to a primary residence. So the same applied here. You could be borrowing 60%, which is what this number represents, so loan to value, meaning you were putting 40% down, no pricing adjustments. Putting down 30 to 39.99%, no pricing adjustments. The only time a second home incurred a pricing adjustment was a tiny little quarter of a point adjustment if you were putting down somewhere between 14.99% and 10%. 10% on a second home is the minimum down payment required for that type of a transaction. So if you were doing maximum financing and looking to borrow 90% of the sales price on a second home purchase, you would have incurred a quarter of a point one-time transaction expense based on the loan amount. So this is not a quarter of a point to the interest rate, but very simply, if you were borrowing $100,000 on a second home purchase, you would have paid a fee of $250 at the time of closing as a one-time expense. Now, with these new pricing adjustments that came into play, you can see that there are some rather large numbers here as compared to what you're seeing in the first line. So to really simply drive home the significance of what was imposed into second home financing with both Fannie Mae and Freddie Mac, and realize this is top level down. So this is not lender specific. This is any banking or lending or mortgage entity that is looking to utilize Fannie Mae or Freddie Mac for the delivery of a given loan product, and it is a secondary residence. These pricing adjustments come into play. So now, as it stands, if you were looking to borrow that same $100,000 on a second home purchase, you are now going to incur a fee of $4,125 on that transaction. Here, again, it was $250. Here, it is now $4,125. And you can then clearly see that at these different levels of down payment, previously there were no pricing adjustments. Now, even if we go to a scenario here where you are putting down 40% or more, you are still going to incur an add-on or a surcharge of 1.125%. And these all would get multiplied times the amount that you're borrowing. So in the case of this $4,125, that's on $100,000. If you were borrowing, $400,000, that's going to be in excess of a $16,000 surcharge simply because you are looking to purchase the home as a secondary residence, a vacation getaway for you and your family. So if this is on your horizon in the near term future, and again, I don't know if there's going to be any change or update to these policies because we are in, and I don't want to talk about politics, and I'm not going to, but these changes were implemented during a different administration than what we have right at the moment. So I do not know if there is any change forthcoming to these pricing adjustments, but on the assumption that they stay in place for the foreseeable future, if you are considering the purchase of a secondary residence for you and your family, please just be aware ahead of time before you dive into the transaction that in addition to your down payment and in addition to all your normal and regular transactional costs and prepaid items, there is going to be an element here that certainly comes into play. And depending on the price point and the corresponding loan amount for your transaction, it can add up to some significant dollars. So I hope you found this informative. Thank you again for watching. I'm going to jump back into the regularly scheduled programming. So that's it. That's my 4 pros and my 4 cons. Thanks for tuning in. I hope you found this information valuable. If there's anybody else that you know that is possibly in need of this information or would enjoy seeing this video, feel free to share this with them. I want this information to be a resource to anybody that is in a position of needing a mortgage at some point going forward, and want to be as open and transparent with you as possible to just help create a better understanding of all things pertaining to the mortgage lending environment here in the United States as we sit about 3/4 of the way through the year in 2025. Make it a great day out there. If there's ever anything I can do to help you, feel free to reach out. I'd be more than happy to do so. And we'll look forward to seeing you in the next video. Well, hey there. If you are still with me, thanks for sharing a little time with me today. I hope you found this video helpful and informative at any point, and whether that is 2 weeks, 2 months, or 2 years from now. If you have any questions about financing or mortgages for any type of property located anywhere within the state of Florida, please feel free to reach out. I'd be more than happy to have an initial consultation with you, learn a little bit about what your needs, wants, and desires are, and see if we can come up with a loan program custom suited to take care of your situation. If you are self employed, we have solutions in the market today that can help you with that as well. If you have ran into financing issues due to self employment in the past, and if you are seeking standard, traditional, regular financing, we do all those loan programs really well as well. I would be more than happy to consult with you and put my team to work for you. Make it a great day. Thanks for watching, and I'll look forward to hearing from you if there's anything you'd like to discuss. This is Matt, the Fish and Finance Guy, proudly representing Main Street Home Loans, NMLS ID 296861, and we'll see you again in the next video.